Jason Bond on the Bull Microcap Fund. I wanted to give you our investment thesis for Surge Components, ticker SPRS. Surge Components is a low-cost distributor of electronic components specializing in capacitors, discrete components, and audible products. Capacitors, which store electrical energy, are found in everything from computers and appliances to gaming devices and toys. Discrete components perform singular functions, offering more flexibility than integrated circuits, chips, which handle multiple tasks. I'd like to give a hat tip to MicroStan of Microcap Club. Ira Levy and Stephen Lubin have run the company since inception in 1981. They own 18.4% and 19.9% of the common stock, respectively, and are 68 and 69 years old. Surge retains a significant portion of its free cash flow. Importantly, Surge consistently generates return on capital above its cost of capital. Despite trading at a discount to peers, the company delivers superior returns while operating with little to no financial leverage. One of the key concerns with Surge is its capital allocation strategy, or lack thereof. The company continues to accumulate cash due to several factors: no dividend payments, no significant debt obligations, no recent M&A activity, no share buybacks or tenders since 2017, minimal capital expenditure needs. This has resulted in an increasing cash balance with no clear strategy to deploy it for shareholder value creation. Management's historical reluctance to return capital is something to watch. Surge differentiates itself by targeting small to mid-sized original equipment manufacturers across multiple industries, including automotive, consumer electronics, communications, security, and household appliances. Unlike larger competitors, Surge's focus on smaller OEMs allows it to build long-term relationships and provide more tailored solutions, ensuring flexibility and responsiveness to market shifts. Finding a company that consistently generates high return on invested capital while trading at a deep discount is rare. Despite concerns about management's cash hoarding, Surge presents an attractive value opportunity. It boasts peer-leading return on invested capital and return on equity, while trading at a significant discount to median valuation multiples. With management owning 50% of shares, they have strong incentives to unlock shareholder value, whether through buybacks, dividends, or reinvestment. Even if pressured by legal risks, the likelihood of capital returns increases. With limited downside and significant potential upside, Surge Components remains a compelling opportunity. The market cap is $13.4 million, while enterprise value is $1.87 million. Here are the metrics achievements. Enterprise value to EBITDA is 1.43, price to earnings ratio is 17.14, price to book is 0.69, price to cash flow is 7.36, and price to sales is 0.44. Return on invested capital is 31.1%, which is excellent. I use return on invested capital instead of return on equity because return on equity is distorted by a very high cash balance. The Piotrowski F-score is 6, which is decent. As noted above, insider ownership is outstanding at 50%. Cash is $12.74 million, while debt is $1.21 million. Total liabilities to total assets is excellent at 23.4%. Here are the intrinsic value scenarios. Low case, if there's a bear market and or a recession, of course the stock could decline. Also, excessive cash hoarding without shareholder returns could trigger a 20% penalty under IRS regulations. Mid case, the company should trade at a price to book of at least 1.5 versus the current 0.69. That would put the stock at 522, over 115% higher than today's 240. High case, with return on invested capital over 30%, the company arguably should trade at a price to book of at least 2.5. That would put the stock at 870, which is over 260% higher than today's 240. Risks. Key person risk. Management plays a crucial role in inventory oversight, making leadership continuity critical. Accumulated earnings tax risk. As mentioned above, excessive cash hoarding without shareholder returns could trigger a 20% penalty under IRS regulations. China exposure. Less than 20% of manufacturing occurs in China, and only 16% of sales originate there. However, management is prepared for potential U.S.-China economic disruptions.